Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing partner with Budd Wealth Management. We have developed and refined a process over the last 20 years to work with families that aspire to what we call a work optional lifestyle. We help to put all the pieces of the financial puzzle together for our clients. Feel free to connect with us on LinkedIn and Facebook, where we post interesting personal finance content on a regular basis. Mid-year outlook 2021, picking up speed. The US economy powered forward faster than nearly anyone had expected in the first half of 2021. The speed is thrilling, and the overall economic picture remains sound, which may support strong profit growth and potential stock market gains. But the pace of reopening also created new hazards. Supply chains are stressed, some labor shortages have emerged, inflation is heating up, at least temporarily, and asset prices look expensive compared to historical figures. Looking at the new environment, LPL Research's Mid-Year Outlook 2021 covers the economy, policy, stocks, and bonds. Prepare for a fast-paced second half with the economic insights and market guidance in LPL Research's Mid-Year Outlook 2021, picking up speed. The US economy has surprised nearly everyone to the upside as it speeds along thanks to vaccinations, reopening, and record stimulus. We have combined to produce what could be one of the best years for growth ever. The growth rate of the US economy may have peaked in the second quarter of 2021, but there is still plenty of momentum left to extend above average growth into 2022. As a result of the strides made toward full reopening, rapid vaccine distribution, massive stimulus efforts, and support from the Fed, we maintain our 2021 forecast for US GDP growth of 6.25% to 7%. 6.25% to 6.75%. Last year's 3.5% drop in GDP, the worst year since the Great Depression, may not be forgotten, but it has been left in the dust of 2020. Globally, Europe and Japan have been slower to move past the pandemic, but explosive growth may be forthcoming once they do. Meanwhile, emerging markets continue to be a source of solid growth, with several Asian emerging markets being among the first to recover from the pandemic, though growth in the United States could be stronger. Since World War II, economic expansions have lasted an average of 5 years, with the 4 most recent cycles going even longer. Before the pandemic, the most recent expansion was the longest ever at 11 years, and might have gone even longer if COVID-19 hadn't struck. However, this cycle may not continue as long as the last one, considering there wasn't your average recession, because the recession last year was the shortest ever, and the economy was supported by historic stimulus. Some imbalances weren't worked off like we tend to see in a normal recession. Corporate debt levels remain high, supported by low interest rates, and stock valuations never really reset. The good news is the new cycle of growth probably has enough going for it to be at least average, which would still give it another 4 years. and there's nothing wrong with being average. We think many more years of weakness could be in the cards for the US dollar. We view the twin deficits of the US economy, the combination of the budget deficit and the current amount of deficit, mostly due to trade, as a long-term structural driver that may continue to put pressure on the greenback versus major global alternatives over time. During much of 2020 and early 2021, markets have been focused on fiscal policy due to massive government efforts to help the economy speed past the impact of COVID-19 restrictions. Policy still matters, but it will matter far less to markets over the rest of 2021. Markets may anticipate an increase in government spending if Congress passes some version of the Biden administration's Build Back Better initiative, but it will likely be spread out over almost a decade. The biggest risk may be around taxes, with businesses and wealthy households both facing the prospect of a higher tax burden to pay for the plan and help manage the deficit. President Biden has proposed increasing the corporate tax rate to 28%, but that should be viewed as a bargaining position, and we believe the more likely outcome is that we see the rate end up closer to 25%. The negative news for the markets is that corporate earnings growth will take an approximate proportional direct hit. Since the stock market is fundamentally driven by earnings, the tax impact will likely be a headwind for equity markets. On the positive side, this move has been anticipated for quite some time and should not be much of a surprise to the markets. Further excluding the rate introduced by the Tax Cut Job Act, this will be the lowest tax rate in about 70 years. Historically, markets have absorbed higher corporate tax rates, although with below average returns. While we don't think higher rates would be retroactive, they could take away some of the momentum from recent upside surprises and earnings growth that we've seen so far in 2021 and contribute to a choppier market. Proposed household tax provisions to raise funds for Build Back Better include increasing the top tax rate on ordinary income to 39.6% from 37%, and capital gains and taxes on those who earn more than $1 million to a maximum of 43.4% from the current 23.8%. Here is a fun statistic. Only 0.32 of 1% of the population makes more than $1 million a year. So the truth is this won't impact the other 99.68% of the population. Looking at history, capital gains taxes did increase in 1986 and 2013, but the economy was on a firm footing compared with the 1970s hikes, which saw an economy marred by higher inflation and sluggish growth. Not surprisingly, the two more recent hikes saw solid stock market performance, while the 1970s hikes didn't. It is as simple as how the economy is doing. Policy matters, but broader economic trends matter more. We expect the strong economic recovery to continue to drive strong earnings growth and support further gains for stocks. However, after one of the strongest starts to a bull market in history, stock prices reflect a lot of good news. As inflationary pressures build and interest rates potentially rise further, the pace of stock market gains may slow. Here are our market forecasts for 2021, including stocks, earnings, and treasury yields. We see additional gains for stocks in the second half, but they are likely to come at a slower pace and with more bumps along the way. Our forecast is for year-end fair value of 4,400 to 4,450 for the S&P 500. Our forecast for 2021 S&P 500 earnings per share is $195, above the consensus estimate of FactSet and a 36% increase from 2020. And finally, we see the U.S. 10-year Treasury yield ending 2021 between 1.75% and 2%. More on yields in a bit when we get to the bond section. Although no one would argue that this cycle looks like any other we have experienced in modern history, studying the second years of historical bull markets can be instructive. Looking back at the bull market since 1950, as you can see on this slide, the average S&P 500 gain during the second year has been about 13%. If we focus just on bull markets that followed declines of 30% or more, as the current one did, the average gain during the second year has actually been 17%, which would put the S&P 500 over 4,600. Now, as this bull market gets further into the second year, we would expect volatility to pick up a bit. Also shown in the chart, the average maximum drawdown for the index during those 2-year-old bull markets has been about 10%. Given the boost from the reopening and stimulus still working its way through the economy, pullbacks may be short-lived and corrections less severe. Inflation and possible tax increases are among the potential causes of a correction. Coming off a stunning first quarter earnings season with one of the biggest upside surprises ever recorded, corporate America is firing on all cylinders. Not only are earnings expected to ramp up significantly over the remainder of 2021 as the economic rebound continues, but momentum is building as estimates have risen significantly this year. Our forecast for the S&P 500 earnings per share in 2021 is $195, a 36% increase from 2020. We then expect corporate America to build on its strong earnings performance next year and potentially deliver $205 in S&P 500 earnings per share. That 2022 earnings number is a PE of 21.5, get us to our year-end 2021 fair value S&P 500 target range of 4,400 to 4,450. Even as the economic recovery drives strong revenue growth, there are risks to earnings, most notably inflation, which could hurt profit margins and potentially higher taxes. Despite the impressive earnings rebound, valuations are on the high side based on traditional metrics. The S&P 500 index is trading at a forward PE of about 21 times the consensus earnings estimate for the next 12 months, above the post-1980 average of 17. But when incorporating interest rates to get the more complete picture, we find stocks are actually reasonably priced. To compare stock and bond valuations, we can calculate an equity risk premium, which compares the earnings stock generate to that of bonds. The S&P 500 is generating an earnings yield of 4.6%, with treasury yields around 1.4%. The equity risk premium is over 3%, above the long-term averages of 0.8%, and indicating stocks are cheaper than bonds. After one of the worst starts to a year for fixed income, returns might not get much better from here. Long-term interest rates have traded sideways and even lower recently, but we do expect rates to move higher which would put downward pressure on bond prices. Ultimately, investors should proceed with caution this year in the bond market. We are not giving up on high-quality fixed income, though, as Treasury securities historically been the best diversifier during times of equity market stresses. Inflationary pressures continue to build as the economy continues to recover. As one of the bondholders' main nemesises, inflation erodes the real value of principal and interest payments, making them worth less. While we don't believe inflation will be a lasting problem, we do expect higher consumer prices in the near term, which should continue to nudge interest rates higher this year. Moreover, and why we believe copper is an important commodity to watch, as seen in this chart, the ratio of copper prices to gold prices has been an important predictor of where the yield of the 10-year Treasury should be. Copper is an important input price for a number of consumer goods, so as copper prices have increased due to the strengthening of the global economy, the 10-year Treasury yield haven't kept up. While not a perfect predictor, the copper-gold ratio has been a fairly reliable one in terms of the direction and level of interest rates, and one that suggests interest rates could move higher from their current levels. So what does that mean for core fixed income returns? Rising Treasury yields are a headwind to core fixed income returns. And as seen on the slide, projected returns for core fixed income as defined by the Bloomberg Barclays US Aggregate Bond Index through the remainder of the year are low to even negative in certain scenarios. The way to read this table is that if interest rates and spreads don't change at all, index is projected to a return of around 1%. In the best case scenario where interest rates move lower by 20%, and spreads tighten by 20%, both wildly optimistic scenarios, the index would return around 3%. In a more likely scenario where interest rates move higher from the current levels and spreads don't change, fixed income returns are likely to be flat to down 1 to 1.5% for the last 6 months to the end of the year. Because we believe interest rates have the potential to move higher from the current levels, core fixed income returns may end the year with a negative total return, which would be the first time since 2013. Negative total returns don't happen a lot in core fixed income, but it may happen this year. And back to the bond math quickly, as interest rates move higher, future returns get better. So while this year may be disappointing, future returns for core fixed income are likely to be better. No guarantee, of course. So how to invest in this environment? We still suggest investors consider reducing the interest rate sensitivity in their portfolios. Mortgage-backed securities do not offer the upside of corporate bonds, but they can be more resilient in a rising rate environment. Investment-grade corporates tend to be more interest rate sensitive than mortgage-backed securities, which may make them more vulnerable if interest rates rise. However, we still think the short to intermediate part of the corporate credit universe makes sense. For suitable income-oriented investors, adding more credit-sensitive sectors such as bank loans, preferred securities, and emerging market debt to their portfolio may help compensate for the reduced income potential of a low-rate environment. But we still believe that high-quality bonds should make up the bulk of any bond allocation. So, if we're expecting higher Treasury yields and low to negative returns for core fixed income, why would anyone want to own bonds? Frankly, in case something bad happens to cause equity markets to sell off. Core bonds, and more specifically Treasury securities, have historically been the best diversifier to equity market declines. As seen on the slide, when equity markets are down at least 3% during a particular month, Treasury securities were most were mostly positive during the same month. When you consider stocks in the second year of a bull market, and that historically has brought increased volatility, core fixed income can help dampen and potentially offset some of those losses and keep clients fully invested to help them work toward their long-term investment goals. While we still like equities over bonds over the course of the year, we do think high quality fixed income continues to serve a purpose in portfolios. Looking out over the rest of 2021, it seems like the worst of the hard times are behind us. Now we're going full speed ahead, and we all want to take some time to enjoy the thrill after a long period of caution. But these are also the times when planning is most effective. Early in the economic cycle, with the next recession potentially years away, a strong start to a bull market in full gear, and a relatively calm market environment. Right now, in fact, is the ideal time to consult your financial professional on your financial goals, the most effective way to reach them, and how to be prepared for market volatility down the road. LPL researches Midyear Outlook 2021. Picking up speed is here to help you navigate the risks and opportunities over the rest of 2021 and beyond. But your crew remains the key to progressing toward your long-term goal. Thank you for joining our Midyear Outlook 2021 presentation. Please review these important disclosures. Take our risk quiz online. Visit us at budwealth.com and take your virtual risk test. Schedule a complimentary follow-up session to get your questions answered on your own specific situation. Scheduling tool is right on the main page of budwealth.com. You can also email me as a follow-up. For those of you attending that are not clients, as your life unfolds and your goals evolve, our client life process continues to be refined in each of these areas to assist in reaching clients' goals. You can request an introductory kit right off our main page at the very bottom of the website, or you can email us with your mailing address and we will send you our introductory kit for those that would like to learn more about my firm and our client life process. Thank you for attending today. Have a great rest of the week.